Federal Reserve policies, and bank lending rates can impact the cost and return on investment when you make acquisitions. In this video, we're going to model an acquisition of a book of business and how changes in interest rates can impact the financials and the return on investment. Make sure you watch until the end of this video to see the comparison of the three models and the impact interest rates have on the outcome. Okay, let's dive into the details. Let's break down the pieces of the acquisition so we can model out an income statement and a cash flow. Achilles Enterprises will be purchasing Hector's book of business through an asset purchase agreement. The book of business currently generates $2.5 million of revenue, and the purchase price is 2 times revenue. In other words, the purchase price is $5 million. Achilles Enterprise will be financing the $5 million purchase with $4 million of debt, and the remainder will be paid in cash. Let's take this information and model out the result for 7 years. And let's apply 3 different interest rates to the financing and how the different interest rates impact the income statement, cash flow, and ultimately the return on investment. And based upon the purchase that you see here, I'm breaking down the purchase price into the book of business, the covenant not to compete, and fixed assets. That is coming with our price tag of $5 million. In our model scenarios, we're going to do interest rates of 3%, 5%, and 7%, borrowing $4 million over 7 years or 84 months. That's the principal and interest amount when you amortize the loan on an annual basis. For reference, to keep this illustration simple, I won't be using the time value of money or the impact of taxes. If you've gotten any value out of this video so far, please hit the like button and please consider subscribing. All right, let's continue. Okay, let's go over our model. That $2.5 million book of business that we bought, we're expecting that top line revenue, that revenue to grow at 10% per year. The $2.5 million book of business will require $2 million of operating expenses. This will result in $500,000 of EBITDA and EBITDA margins of 20% at the time of purchase. We expect operating expenses to grow at a rate of 4% per year. Once we plug in those assumptions, we can model out EBITDA for the next 7 years. That's what we're doing inside the income statement. Also in our model, we will include the amortization expense of the book of business purchase along with the depreciation of the fixed assets that were included with the purchase. If you go back to page 1, that is this section here. The last part of the income statement is the interest expense from the financing, which will allow us to calculate net income. EBITDA will be our effective cash flow from operations. Please note that EBITDA as cash flow might not always be appropriate for manufacturing or any business with significant assumptions or estimates. It does work well with service-based business, and Achilles Enterprise and Hector's book of business are service-based business models. Financing the investment is a loan that amortizes over 84 months, as we mentioned before. The loan interest rate is a fixed 3%. The financing repayment will be factored into the cash flow, ultimately getting our annual excess or deficit cash flow for the year. I also want to note in the initial acquisition, we did put $1 million down to buy this book of business. So we have cash going out the door that wasn't financed in 2024. Now, debt servicing, when you look at here, it is principal repayment and interest. And at the very bottom of the cash flow, we're going to track the accumulated cash flow from each year. This is going to give us our return on investment. Now, looking at the cash flow, looking at our model, with financing the book of business acquisition at 3% interest, we will break even in year 4, and we will generate a cash flow return on investment of $4.2 million by year 7. So what does this look like at a higher interest rate? Let's see how that impacts the financials when we have a 5% financing charge instead of 3%. As you look at the P&L, you'll notice EBITDA is exactly the same. There is no difference between the 3% model and the 5% model. The operating results and assumptions are not impacted by the change in interest rate. Below EBITDA, you will notice the increase of interest expense. This is a result of the higher interest rate. This will also result in lower net income on the income statement, comparatively speaking. Dropping down to the cash flow, you'll notice the debt service is higher as a result of the interest rate. This is where you can see the impact of the higher interest rate on the ultimate cash flow at the end of the day. And this will impact return on investment. In this model, after 7 years of running a 5% financing of $4 million, we end up with net accumulated cash of 3.9, where the 3% model, it was 4.2. Now, let's look at a model of 7%. Same model expenses for revenue and expense growth. The only change here is the interest rate is now 7%. What you'll notice again here on the income statement is the interest expense has increased. If you compare it to 5%, compare it to 3%, there is a noticeable difference in interest expense. And if you drop down to the cash flow, same thing is happening with the cash flow. It's going to take more cash to pay back the loan, which will ultimately reduce the amount of cash flow, or accumulated cash flow, this investment is going to ultimately generate. And with this model at 7%, we end up with accumulated cash at the end of year 7 of 3.5 or 3.6 million of accumulated cash flow from this investment. So let's compare all three models, financing at 3%, 5%, and 7% interest. And as stated before, EBITDA is the same across the board. It does not change. Our assumptions, our operational results are identical. Interest rates do not impact EBITDA. And I also want to look at year 7 net income. Year 7 net income across the board is fairly comparable, even at the 3, 5, 7%. Now, earlier years, net income is not going to be as close, but by the time we get to year 7, when the debt's almost paid off, our net income is fairly comparable. That's because we've repaid most of the debt at this point, and even at a 7, 5, 3% interest rate, the interest is going to be minimal. So we're working towards net income comparability. So Patrick, what the heck is the point of the video? If your EBITDA is the same, your net income is the same, well, let's look at the cumulative excess cash flow, because that's going to have a pretty big difference. 3% financing is the best option. That is just very obvious from the get-go. 3% interest rate, a 3% interest rate on financing will generate $631,000 excess dollars compared to a 7% interest rate. And it'll also generate $309,000 excess dollars over a 5% interest rate. In other words, you'll have $630,000 more at the end of year 7 if you get a 3% interest rate compared to a 7% interest rate. Or you'll have $309,000 extra dollars at the end of the year 7 if you have a 3% interest rate versus a 5% interest rate. Also, comparatively speaking, if you had a 5% interest rate, you would have $322,000 extra dollars at the end of year 7 compared to a 7% interest rate. The interest rate does have an impact on the return on investment, which is ultimately the cash flow you've generated on this investment. Now let's look at return on investment, ROI, and compound annual growth rate, CAGR, to see how those percentages calculate based upon the cash flow our investment generated over 7 years. I also have a video that shows you how to calculate return on investment and compound annual growth rate and why they are different. I'll link that video in the description. Check that out after you finish watching this video. 3% financing generated a return on investment of 84%, which on an annualized basis, which is compound annual growth rate, CAGR, it was 9.1% over 7 years. 5% financing resulted in a 78% return on investment, and this was a compound annual growth rate of 8.6%. 7% financing resulted in a return on investment of 72%, and this was a compound annual growth rate of 8%. So you could see how interest rates does play a factor on your return on investment. This illustrates that interest rates do have an impact on your return on investment. It will ultimately impact the cash flow that you're generating if you're using debt financing to finance acquisitions. What I want to illustrate is not lower interest rates are better. That's true. The point is to illustrate how the interest rate environment can impact your investment's results. And if interest rates were really high, you might not be making this investment, or at least considering alternative ways to finance the transaction. On the other hand, a lower interest rate environment can encourage these type of investments since you can generate higher returns on your investment and acquisitions. Timing and what the market is offering does play a factor when you make investments and the ultimate return on those investments. Thank you for watching the video. I hope you learned something. Have a great rest of the day, and I will see you in the next one. Take care. Goodbye.